She said no decision has been taken so far.
We are live. We are
To
live.
name the banks.
We are going.
Well, but in her budget speech, she said that she's going to do something.
Yeah. Naming.
We are going to start the meeting.
Yeah, please.
All others are requested to please keep their microphone mute. Respected Professor C.P. Chandrasekhar, distinguished guests who are participating in this program. On the occasion of the 52nd year of the bank nationalization, Bank Employees Federation of India has given call for campaign throughout the country, and our different state committees are indulged in webinars, meetings at all levels. From headquarters, we have planned a series of 4 talks by eminent personalities, and today we are beginning our first program with Comrade C.P. Chandrasekhar as the main speaker. I request our General Secretary, Comrade Debashish, to deliver the welcome speech.
Well, good evening, comrades and friends. I welcome you all on behalf of Bank Employees Federation of India to this evening's webinar, which is being held on the occasion of 53rd Bank Nationalization Day, which fell on 19 July 2021. Now, the whole country, particularly the bank, is facing steep challenges. Challenges in the last 52 years, which we did not observe, though the indications were there that to turn the wheels backwards. We know that 52 years ago, 14 then largest private sector banks were nationalized on 19 July 1969. At the height of the then bank employees movement, as well as a demand of the common citizen of the country. And after that, in the second phase in 1986, more banks were nationalized. At one point of time, there were 27 public sector banks in our country. Now, since 1969, till the later part of 1980s, the nationalized banks plays a huge and important role in making a sovereign economic position of the country, expanding its services to the nook and corners of the country, and particularly rendering services to all sections of people. And we know that since early 90s, with the advent of new economic policy, successive governments have started reforms the banking sector with an ultimate aim of privatizing the public sector banks for the interest of a section of the big corporate houses of the country. Now, today we are facing a challenge that the present administration, particularly who are ancestors of the then Swatantra Party and Bharatiya Jana Sangh, who opposed the very idea of public nationalization of the private banks. Now, with their coming in the helm of the power in 2014, they are pushing through the agenda of reforms in a very brisk manner, and particularly while announcing the budget for the year 2021-22, the Union Finance Minister on 1st February announced for privatization of 2 public sector banks. Now, this is the challenge being faced by the bank employees movement, a new challenge. We have been facing this challenge for the last 3 decades, during which we opposed many policies of the government in order to make paradigm changes in the performance of the public sector banks. And so far, except IDBI Bank Limited, all the public sector banks, now the number has come down from 27 to 12. Still, these are all under public sector. Now the challenge that we have to force the government to retrace its decision. So far, no names has been announced, but we should not be complacent enough for this. And particularly, we are holding these webinars in a very changed situation. Now with several restrictions being in force due to this pandemic, we are not only positioned to hold physical meetings or seminars. So we are also utilizing these social media platforms, these alternative platforms, to create awareness among the section of bank employees in order to take this awareness to the common people of the country, without whose support this fight cannot be fought. So these webinars are a part of our movement. And of course, we shall try so that most of our members, particularly at a time when more than 70% of the employees in the banking sector have entered the bank in the last 10 years. So they are very new, they are very young, energetic also. And these are the forces with which we have to fight this battle. So we are fortunate enough that we have Professor C.P. Chandrasekhar with us. Professor Chandrasekhar needs no introduction. Particularly ideologically, it is completely synchronized with. So I think that all of us who are participating in this webinar will be enriched enough with the valuable speech of Professor C.P. Chandrasekhar. I'm also thankful to him on behalf of Bank Employees Federation of India. And with this, once again, welcoming you all, I will request Comrade C.J. Nandakumar to continue the proceedings. Thank you, comrades.
Thank you, comrade. Now we will hear the eminent economist, distinguished columnist, and also an excellent teacher for all of us. I request respected Professor C.P. Chandrasekhar to give his speech. Please, sir.
Thank you. Thank you. I should begin, of course, by thanking Befi and all of you all for once again inviting me to be part of the efforts which have been underway for years now to try and ensure that we have a banking system which is in keeping with the needs of not just a few corporate houses, but really in the needs of, to serve as an instrumentality of development and to meet the needs of the people at large. Of course, as has been mentioned, this is the 52nd year after nationalization, more than 5 decades. But as we go down this trajectory, each year becomes more significant because the pressure to try and unwind or dismantle all that was sought to be built in the period, at least in the 2 decades or 2.5 decades, which followed bank nationalization, first round of bank nationalization in 1969. That effort has been gaining in intensity. Now it's a declared objective of the state to try and pull out of the banking system. But what I plan to do today, since most of you are familiar with the details of nationalization, the consequences it had, the major achievements of the nationalized banks, not just till 1991 when we entered into a new era, but even after that. So what I want to do is to really look at certain contradictions which have emerged over a period of time in the policy of the state vis-a-vis the banking system, which it predominantly owns even today. And to suggest that those contradictions actually provide an opportunity to be able to hold back or push back, if not completely overturn the effort of the part of this government, and this is not just this government, to try and, as I said, undermine the achievements of nationalization. Sorry. So I wanted to start by sort of briefly, asking the question, why did nationalization become so imperative at the end of the 1960s? And we do know that that this was part of a set of policies which came in that era, in the period after the major crisis which India saw in the mid 1960s, which essentially tried to, at the margin, address the problem of the inequality which was inherent in the development path that India had been seeing, even in the Nehru era. We know that despite the promises which were made to break down land monopoly, to institute land reforms, to undermine asset inequality in the corporate sector, to sort of hold down monopoly, to prevent any further concentration of assets in the industrial sector and in non-agricultural sector in general, in the hands of a few capitalists, that in practice, none of those really got implemented in any significant way. There was some effort which were made in a couple of states, which were followed up, states like Kerala, J&K, to a certain extent Karnataka, subsequently West Bengal, and so on. But we know that generally the promise which was there in the kind of resolutions which the All India Congress Committee had adopted periodically in the period prior to independence, of undermining asset inequality as a basis for being able to generate not merely a trajectory of relatively high growth, but a process of growth which would be better distributed, more inclusive. And it was becoming clear that by the time we got to the mid-1960s, to the government as well. So we had the Dutt Committee, which was the Industrial Licensing Policy Inquiry Committee report. We had the Mahalanobis Committee on Income Distribution and the Levels of Living, a Planning Commission report. All of them obviously were concerned about the fact that we were going through, or we were on a trajectory in which, in practice, inequality was not merely persistent, but in fact inequality seemed to be intensifying. In particular, the Mahalanobis Committee was pointing towards it. And at that point of time, there was an effort to try and think of a set of policies which could at least prevent the worsening and to a certain extent redress this tendency towards increasing inequality, which is characteristic of India's very specific mixed economy based capitalist path. So we had the MRTP Act, which was passed. We had the FERA Act, the Foreign Exchange Regulation Act. We had, of course, prior to that in 1969, bank nationalization and so on. So you basically had a situation where you had a state at that point of time trying to intervene to hold back any tendency towards a worsening of inequality as part of this trajectory of growth. And in that, nationalization of banks was seen as important because it was clear that riding on the basis of the asset inequality which existed particularly in the industrial sector, monopolies which had then had ownership or had taken over in some sense the banking system from the British in some sense, that the battle between domestic capital and British capital in the banking system had really began. Am I audible and visible? Yeah. Yeah. Okay. Because suddenly the screen seems to be changing. Okay. So I'm continuing, presuming that y'all are able to hear me. So the whole idea was that while the battle between domestic capital or domestic industry
who is presenting? Please stop. Who is presenting?
Hello.
Continue, sir. Please continue.
So we ended up with a situation in which that handover which occurred was a handover to big business in India. Many of these banks were owned by business groups, and therefore it became clear that in some sense the control over national savings, because after all banks are the first port of call of people's savings, because they are where people take their savings at first instance too, even if they plan to spend it in bulk form, in some bulk form to acquire assets over a period of time. The first port of call of savings is the banking system. And it became clear that using the leverage they got out of ownership and the leverage they got out of, therefore, the control over national savings, these business groups, these monopolies were in a position to be able to divert this savings in order to further their own interests as far as capital accumulation is concerned. So we had a situation where, as all of you all are familiar, even if you go to the mid-1960s, only about 2% of total credit went to the agricultural sector. Very little went to the small-scale sector. A large part of it was basically concentrated in industry and trade, and it was concentrated in the hands of units which either directly or indirectly seem to be related, as the Dutt committee pointed out and the Manakabas committee pointed out, seem to be related to the business groups or the directors of the business groups who were also directors in these banks. So in some sense, what we had was a situation in which the reason why nationalization occurred was a conviction that if you wanted to ensure that you'd be able to use national savings for the public purpose and allocate it in a way across sectors and across, of course, sections of the population in ways which are more inclusive, and you want to do it with a certain degree of stability, because there were signs by the early 1960s of considerable instabilities in the private banking sector. Lakshmi Bank, Palai Central Bank, many of these banks were closed. And at the time they were closed, we didn't even have deposit insurance. Deposit insurance came after that. So you really had a situation in which neither were banks serving as an instrumentality for growth other than that of the big business groups themselves, nor were they inclusive in terms of the distribution of credit and therefore the impact that they had on the trajectory of growth, resulting in an increase in inequality, both in intersectoral inequality as well as vertical inequality between different sections of the population. But also there were signs that this wasn't a stable system. There was instability. So it was to deal with this kind of, this was not some kind of a fundamental transformation of the system, as it were. It was at the margin to prevent pre-existing inequality from leveraging the banking system for its own purposes, resulting in an intensification of the inequalizing tendency in the growth process. And if you look at it from that point of view, that is from the point of view of actually ensuring that there was credit provision which actually supported more broad-based growth, credit provision which was more inclusive over a period of time. We know that 40% of credit went to the priority sectors as defined at that point of time, which was quite targeted. And of course, we had stability because of the fact that with banks being increasingly publicly owned, the possibility that they would fail really was undermined, because the state, with the support of the central bank, could always ensure that even if a bank is faced with difficulties, the central bank, through its role as the lender of last resort, can ensure that it survives those difficulties and is brought back to health in some form or the other. So this was the intent. And as I said, if you judge what bank nationalization did in terms of these objectives, all of you all are familiar. We have enough evidence, enough reports, enough studies which have actually established that in terms of increasing the credit deposit ratio, without migration of credit, let us say, from rural areas to urban areas, to directing this credit in ways in which there is far greater degree of inclusiveness, with a flow of credit to agriculture, the medium and small scale enterprise sector, etc. A substantial increase in small borrower accounts. And finally, of course, that all of this was achieved in a context in which you not merely brought the unbanked into the banking sector, but you offer them this credit in a way which, despite the distribution of that credit to sometimes remotely located small borrowers, the system itself had a high degree of stability. The system was quite resilient and could continue to play this developmental role. Now, the point about this kind of a perspective of
Your voice frozen.
3 decades, during which we fundamentally moved away from the kind of policy perspective and policy regime which even after the inequalizing growth up to the mid-1960s, was attempting through measures, like I said, the MRTP Act, the FERA Act, the Foreign Exchange Regulation Act, bank nationalization, was trying to address this inequality. And so you're really talking about not merely a regime in which the state had to play an important role, public ownership was seen as being very important. We had large public sector even well before bank nationalization, but it was also one which essentially was attempting to try and at the least prevent a worsening of inequality because of the inequality of asset distribution, which underlay the development trajectory which India had pursued in the period even before 1969. But as I said, however, if you look at it, if you look at these 5 decades, 3 of these decades were decades in which that kind of a policy regime was given up. We saw a dramatic shift under the Congress in 1991, where virtually riding on the back of a balance of payments crisis, a massive foreign exchange stringency, the government decides to not merely go to the IMF, but in some sense to internalize a whole strategy of growth, where instead of being an authority which tries to govern the market, to put in place regulation which would actually try and keep inequality under control, even within a capitalist path, that you had a decision which was basically taken, that is, we have to move away from this kind of a trajectory. And when we move away from this kind of a trajectory, we are obviously going to also rethink the question of public ownership of the banking system. Now, so there are 2 issues here. Firstly, when did therefore the sort of threat to public banking in terms of public ownership first come? And we know that this came in 1991. I mean, right at the beginning itself, we had, by the time we reached 1996, we had both the Narasimhan Committee reports. The first one, which was a more generalized report on financial reforms, and the second one, which was focused on reform of banking. And at that point of time, it was declared that the medium term, in fact, in the case of the Narasimhan report, it wasn't even medium term; it was going to be near term. In the medium term, the intention should be one of really gradually, or if not rapidly, diluting public ownership in 2 ways. One is by bringing the private sector into the establishment of new banks through a system of licensing a set of new private sector banks. And the other, of course, was through the dilution of public holding in the public banking system over a period of time, such that you would increasingly see a greater role for the private sector in the banking arena. Also, the point is, if you say that there is actually a change in policy regime, where the intention of the policy regime no more with the set of objectives which govern, whether successfully implemented or not is a different matter, but at least ideologically, in principle, governed the kind of policy regime we had till 1991. If you say that we had moved away from that in after 1991, then the question which obviously arises is that, then does the persistence of public banking, actually mean that we are still, or we were and continue to be still in a world in which we were in the period between 1969 and 1990? And I'll explain why I think we should consider this issue. And what we actually had is that if you look at it, the period of the 1990s was a period of transition. It was a period in which, bold statements were made by the liberalizers. The Narasimhan Committee embodied those bold statements. In initial attempts at licensing private banks, new private banks had begun, etc. But neither was the private banking sector which was created all that stable. They had multiple mergers, many closures, some of them, because of involvement in activities in the stock market, etc., like the Global Trust Bank and so on and so forth. So, there was no great credibility in the new private sector banking which was established, which made it appear that it was better in some sense than the public banks. But more importantly, what you actually had was that this was a period in which, despite the stated objective, the dilution of equity, say equity holding in the public banking system, couldn't proceed to any significant degree. Really, if you're thinking of a period in which the new regime, the new policy regime began to target public banking, this really happened in the years after around about 2002, 2003. Now, however, in that period, let's say in the decade starting from about 2003 or 2004 and going up to 2014, the focus of the state, which was at that point of time now seeing itself as a facilitator of a private sector-led growth strategy, in which redressing inequality was not a prime objective. In fact, the idea was to try and incentivize the private sector to offer it a lenient tax regime, to try and provide it support in various kinds in order to be able to expand its arena, that you really had a policy regime in which the state now was openly trying to engineer, in some sense, a redistribution of wealth from the nation at large to a small segment of big business. Okay, so you actually had, as Joseph Stiglitz put it in the case of the United States, he basically said that what America saw in the period after the coming of Reagan, which was the neoliberal era in the United States, was in the history of capitalism one of the most severe, or sort of most stark attempts at an engineered redistribution of income from the bottom of the pyramid to the top. And in some sense, the kind of neoliberalism which we began to see in the period after the early 2000s in India was also that kind of an effort. And in that effort, the objective of the state vis-a-vis the public banks shifted from what seemed to be the objective as embodied in the Narasimhan Committee reports. And the way it shifted was that the state, now with hindsight, it appears, decided very clearly at that point of time to begin to use the public banking system as an instrumentality to realize this objective. And what we know is that the consequences of that was, first, of course, we saw this huge credit boom because of a large increase in liquidity in the economy as a result of the inflow of foreign capital. A lot of that liquidity went and settled in the public banking system. The public banking system was therefore forced to increase the volume of lending it undertook. We had a huge increase in the ratio of outstanding scheduled commercial bank advances to GDP from something like 20% to something like 55% in a period of about 10 years, when GDP itself was growing at 8 to 9%. And the whole point was that a significant share of this lending now went to try and bring big business, big corporates into areas which earlier were reserved for the public sector. So the whole idea was that instead of getting them to risk their own capital, if they wanted to move into areas like power generation, power distribution, roads, ports, civil aviation, and so on, or telecommunications, that what you would try and do is to actually leverage the public banking system to provide them huge support in order to make these investments. So the consequence was that not only did lending to industry remain large on a growing base, on a growing credit base, but we know that the share of that lending to industry, which went to these new areas into which big business groups, which were in some sense being paid off because they were being submitted, being opened up to competition from international capital, was now being paid off in terms of giving them the space in areas which was earlier reserved for the public sector. And the way in which they were being incentivized to enter into those areas was to leverage the public banking system to offer large volumes of credit, so that we know that out of the total credit which went to industry, which of course was growing hugely, something like from about 3% of total credit which was going to the infrastructural sector, including areas like power generation, distribution, etc. We soon ended up with something like 35% going to this sector. And we also know now, with hindsight, that the expectation that providing them, using the public banking system as this instrumentality for a new liberal strategy in which you're trying to now openly engineer redistribution of wealth in favor of a few business groups, some of which are part of the are virtually like crony capitalists. You're ending up with a situation in which you have this loans which are provided, not really giving them the basis or the possibility of actually now successfully entering these areas and sort of generating large profits and leading up to huge accumulation, but really a situation in which many of them couldn't, despite the support which was obtained in terms of this credit, generate for themselves the net revenues, which was even adequate for them to be able to meet their debt service commitments, to pay the interest and the amortization which was associated with the large amount of lending which was provided to these business groups. And it went into all sorts of areas. It also went into, tourism infrastructure was declared a sort of priority area. So we had lending going to, the Leela hotels because they were seen as part of tourism infrastructure. And we know large part of that debt has gone bad, etc. So you really had a situation in which, instead of at that point of time focusing on the kind of objectives which were embodied in the Narasimhan Committee reports, where you really want to just hand back control, which had been taken over in 1969 from the corporate sector and kept in the hands of the state, so that control over national savings was now in the hands of the Indian state, and it was used for that purpose in the period up to 1991 or even till 2000. Now what you actually had is a situation in which the state was using its control over national savings in order to, in some sense, shore up and help the expansion and accumulation, it was hoped, profitably, on a profitable basis, of a segment of big business without actually having to hand over the banking system to them. Okay, so it was really like providing guaranteed credit to the private sector, because of the fact that we now know what really happened, that as the non-performing assets built up, you didn't record this as non-performing assets for a considerable period of time, because you took this to the corporate debt restructuring cell. You treated these assets as restructured standard assets. You had multiple restructurings for some of the big corporate groups, including the conversion of debt into equity and so on. And it's only when finally this process couldn't be sustained that you had to bring these non-performing assets onto the books of the bank, declare them in the open, and that obviously made it difficult to continue to sustain at the same level, though it hasn't disappeared. What had happened? So this is, I think this transformation which I would argue, this transformation of the perspective which the neoliberal state had with respect to the public banking system is crucial, because of the fact that what it did was that instead of following a trajectory which would have been very difficult, given the fact that we still have an opposition, we still have trade unions, we still have parliament, and we still have elections and so on, that would have been difficult to actually just hand over on a platter the public banking system to private capital, to big business. That what you actually did was you used the public banking system as an instrumentality to shore up the rapid accumulation of capital in the hands of segments of big business. Now, when that failed, obviously, the question became, how are you going to address this? How are you going to address the fact that you're sitting with all these non-performing assets? And we know that, we've gone through many versions of trying to resolve this problem. But one of the things which was initially suggested was said that, listen, these banks have to recapitalize themselves. And the way they can recapitalize themselves is by issuing equity in the open market. For this, we should allow a situation in which public holding can come down even below 40%. And they would use that capital, which they mobilize from the market, in order to recapitalize themselves, write off these loans, so that you get a twin benefit or a triple benefit. Benefit number one, you pay off big capital without getting them to actually return the loans and do whatever they can with the assets that they have. Benefit number two, you actually, get to write off these loans, not with money which comes out of the state budget, but you get to write off these loans despite public ownership by actually going in for privatization if it works. And of course, point number 3 is that this over a period of time would mean that you're going to be diluting the share of the public sector in total equity holding in public banking, beginning to realize in phased manner the sort of objectives which are embodied in the Narasimhan Committee reports. Now, there was a basic contradiction in this, because who would buy a bunch of banks which are sitting with large volumes of non-performing assets on their books? Why would any private investor do that? So therefore, it became clear that you just had to turn to Indonesia after the Southeast Asian financial crisis. The Indonesian government had to virtually recapitalize and take over the Indonesian banks, and it is only after they cleaned the books of these banks that they could actually sell it back to the private sector or sell it to the private sector. So it's clear that you can't have privatization in a situation in which banks are sitting with large volumes of non-performing assets. So then it became that. So where do we go from here? And the second step was to try and see whether you can, in stages, recapitalize these banks. So we had a number of, we had in the Dhanush, and we had another 2,75,000 crores of recapitalization, etc. You kept trying to recapitalize in stages over a period of time, the public banks. But it became clear that given the government's unwillingness, given the neoliberal fiscal policy it was adopting, and therefore its unwillingness to actually show large expenditures on its budget, it was becoming difficult even after adopting, schemes like issuing recapitalization bonds, which was just a mere sleight of hand. You actually had a situation in which you have these bonds which are then transferred, in return for which the government actually says that, okay, I have this money with which I'm going to buy your equity. But in essence, it doesn't show up in the fiscal deficit because of the fact that there is, on the one hand, there is an acquisition of equity. On the other is the sale of bonds, which are then bought up by the banks themselves, which would buy these bonds because of the fact that they are considered of obviously being government bonds, gilts and secure and so on and so forth. But even trying all of that, it became very clear that the problem was so deep, which had been created as a result of this neoliberal attempt to use public banking as an instrumentality to shore up big business, even under public ownership, that the amount of money which you would need for a full-scale recapitalization was something which the Indian state was not willing, as part of its neoliberal fiscal reform, which focused on keeping the fiscal deficit low, that it was not in a position to be able to undertake that. So really, if you look at it, there is a fundamental contradiction which the state has run into. There's a contradiction between its attempt at a certain point of time to use the public banking system as an instrumentality to shore up big business, and its desire, as reflected in the Narasimhan Committee reports, to privatize these banks. And therefore, we really have now all sorts of experiments. We had the IBC, the bankruptcy in the Insolvency and Bankruptcy Code. We are having now talk of one specific asset reconstruction corporation, which of course is going to be funded by the banks, which is going to issue security receipts in order to buy up the bad assets of the banks. And those security receipts are going to be guaranteed by the state. And because they're guaranteed by the state, they would not be treated as bad assets on the books of banks. You're again trying to do all sorts of sleight of hands, all sorts of accounting manipulations, just as much as you did with the recapitalization bonds. You're now trying to create this asset reconstruction company in which banks invest a certain amount of money. That amount of money is used to buy to pay up the cash component of the discount which is associated with what you're buying. The rest of it is in the form of security receipts. A lot of those security receipts sit obviously with the banks, which are holding it till such point of time till actually those bad assets are sold. That if under normal circumstances would not be considered to be a standard asset. but you try and convert that into a standard asset by getting the state to provide you with a guarantee against those security receipts. These are all a bunch of games. It actually reflects the contradiction involved in trying to resolve a problem which is actually created because of the fact that you tried to use the public banking system as an instrumentality for the redistribution of wealth in favor of a section of big business. Now, what's the implication of this? The implication I would derive is the reason why they have not been able to push ahead with their privatization plans as embodied in Narsimham 1 and Narsimham 2. So by the time we were at 1998, the whole plan had been laid out in the public domain. The reason initially, of course, was that it's very difficult to do this in a democratic context in which there was so much opposition, and there exist still segments which would fight, even if you say that, what is the priority sector had been completely diluted. Money was going to lots of areas where it shouldn't. Direct credit to agriculture was being substituted by indirect credit. You were providing money to seed companies and calling it priority sector credit to agriculture, etc., etc. You were doing all that, but still, there was a component which mattered, and there were people, there were political parties, there were democratic forces which were willing to stand up and try and fight to retain that. So during the 1990s, the effort was on, but really you couldn't proceed far enough with it. But I think after the 1990s, the state has actually got itself into a trap in which privatization has become a problem unless it is willing to give up its own neoliberal fiscal stance. It says that, listen, I don't care. I'm going to write into my budget quite a few lakh crores. I'm going to recapitalize these banks, and then I'm going to privatize them if the political system allows me to. But if you're not willing to do that, to proceed with privatization is going to be difficult. And all of these experiments, after Sarfazi, all which came after Sarfazi Act, which is including the IBC, including the ARCs, including the so-called new big, bad bank, big bad bank, and so on and so forth. All of these are sort of efforts to try and somehow get rid of this contradiction in which they have found themselves stuck. And because they are in that contradiction, I think there is an opportunity. There is an opportunity to actually prevent. There is an opportunity to prevent going down the line of privatization. But exploiting that opportunity requires two kinds of things. First, it requires creating an environment and a social sanction where the state is in a position to be able to mobilize through taxation resources, which it can then use to recapitalize the banks and bring them back to solvency. And in solvency as defined, by some kind of a capital adequacy ratio. Till such time as you can do that, you just print money, get the central bank to print money, use that money to actually recapitalize these banks and put them back on a footing, keep them in the public domain, but in the medium term also, go back to using them not as an instrumentality of actually pursuing a neoliberal strategy of a kind, which essentially involves, as I said, an engineered redistribution of income from the bottom of the pyramid to the top, but rather to strengthen the effort which was launched post-1969 to actually create a banking system which is an instrumentality for public good, in which it not merely facilitated growth by using a sort of supply-side credit provision push to economic activity, to do this in a fashion which is more broad-based and inclusive, sectorally as well as in a vertical sense, and to ensure that this occurs without any difficulty in terms of instability in the banking system. We need to go back to that. But in some sense, if we sort of hark back to the past, I do think in the final analysis, the sustainability of that, because as I said, if you look at bank nationalization and what it achieved with respect to the stated objectives of bank nationalization, which is to promote growth, make growth more inclusive, and to ensure stability, it was a thumping success. If yet the pressure to move away from that just on the basis of laying down a bunch of documents which says that, oh, these banks are inefficient, they're bad, and so on, where all the evidence with respect to credit provision, with respect to the degree to which uh, there's inclusiveness in the distribution of credit with respect to stability, etc. Without looking at that, you basically say, you invent all sorts of weaknesses in the public banking system and make the case that it should be privatized. That partly comes because of the fact that the underlying trajectory, which we are pursuing, is a trajectory which in some sense has failed. And because the underlying trajectory had failed, not only now, of course, now the nature of the failure is very different because of the impact of neoliberalism, but had failed even by the mid-1960s, that we have to think of a trajectory where if you want to create conditions in which public banking can do what what it's supposed to do, or at least what was sought to do with it in terms of a development instrumentality in 1969, then you need an underlying trajectory to be able to, an underlying trajectory which would be able to, in some sense, push for a more equalizing growth strategy, which actually has to look at addressing the inequality of asset distribution, particularly now, not so much anymore in the rural areas, but I mean, in agriculture per se, of course, in the rural areas, yes, but in the non-agricultural sector, and therefore have a more inclusive growth strategy. That seems to be what we need in order to be able to give resilience to reviving and ensuring the persistence of a trajectory, which we did with success of one kind in the period after 1969, but which has got undermined even without privatization in the period after 1991, but particularly after 2000. And as of now, even despite the talk of privatization, I think the real problem is that the state is caught in the contradiction that, having used the public banking system as an instrumentality for these purposes, it is stuck in a situation where it can't proceed with the privatization agenda. So it gives us a window of opportunity which must reinstate not merely what private banking did in the period public banking did in the period from 1969 to the late 1990s, but does so within the context of a growth strategy which provides it a real economy base for that kind of financial intervention to be sustainable and resilient. I think I'll stop there now and we can have a discussion.
Okay. Thank you, Professor. You have enlightened us with the pre-nationalization policy regime's intention and what has happened post 1991. And you have given a ray of hope by stating that due to the contradiction faced by the present regime to push forward their agenda of privatization, we will get an opportunity to intervene. That's a very encouraging indication given by you. Many participants in this webinar are really followers of your column in both business line and front line. Especially you have exposed the failure of the insolvency and bankruptcy code by writing an article with the title, A Non-Performing Code for Bad Debt. And you have very authentically given figures and facts that this was a total failure, and now the government is moving towards another mechanism by name bad bank or asset Asset Reconstruction Company Limited. So I hope that you will give some more time to us to have some meaningful interaction on the topic. I request the participants to raise pertinent questions and seek necessary clarification during this half an hour period. I think some queries have been put in the chat box. Can you see and read it in the chat box, sir?
Yes, I can.
If you can please go through that and try to clarify. After that, if anybody wants any more clarification, they are free to put their comments on the chat box.
Yeah.
Thank you, sir.
Well, there's one question. The first question I can read here is Narasimhan Committee was against evergreening of NPAs, but by forming ARC or bad bank, they intend to evergreen all NPAs at the cost of national assets. Well, the Narasimhan Committee was against evergreening of NPAs on the basis of its assessment that the reason why you had NPAs was because of too much of too much of directed credit, that using a high SLR, a high CRR, but more importantly, a high SLR, a high statutory liquidity ratio, you are preempting credit for the government. And by using the priority sector directed credit scheme, you were pushing banks to lending into areas where you basically were lending to those who would not be in a position to be able to meet their debt service commitments. And therefore, it basically saw the problem of non-performing assets as being a problem of what bank nationalization or what the objectives of bank nationalization were, which is to try and use the public banking system as an instrumentality for development on the basis of actually, providing credit which will support growth, and growth which would be inclusive by directing credit to areas like agriculture, 18%, small industries, etc. So the Narasimhan Committee's notion of evergreening of NPAs not being NPAs was basically therefore to say that isn't the only way you can finally not keep getting NPAs of this kind is you stop all this, you stop preempting credit, you stop, having this priority sector norms and so on over a period of time. In fact, they had such a strong set of recommendations with regard to reducing the amount of directed credit, down to 10%, if I remember the figure exactly, that the RBI had to state that this is not yet the time where we can do something like that, because there was too much pressure. You can't suddenly say, I'm going to go from 40% to 10%, and that too not on the basis of very specific distributions across sectors. So I would sort of distinguish between that kind of evergreening of NPAs and the kind of evergreening of NPAs which we are seeing now. The problem now is that the NPAs are there, which are there. You want to prevent evergreening of those NPAs by getting them rid of them through some scheme of write-off. Now, any scheme of write-off would involve some substantial haircut, which will imply losses for the public banking system. And therefore, it has to put that public banking system through a process of recapitalization. And that recapitalization, if it is not funded with money from taxes, even if in the interim you use money printed by the central bank, is really going to be a process. It's really going to be a process in which you would not be able to achieve this within the framework of a neoliberal fiscal regime. You can't say, I won't tax too much. I'll give huge tax concessions as I gave in September 2019 during the recession, and in the form of a completely revamped corporate tax slab. They changed the slabs for corporate taxation, brought it down hugely, lose therefore large amounts of corporate tax revenue. have no real, inheritance or estate duties or taxes of that kind on wealth. You can't do that and then say that, listen, I'm going to be in a position to be able to recapitalize these banks while maintaining a fiscal deficit to GDP ratio, which you think has to be targeted at some level, So I think, what we are seeing now is them trying to find a way in which they can, in some sense, make these NPAs disappear without taking too much money out of the central budget. And once that disappears, then go ahead with the plank of privatization, because you know that you cannot privatize in a situation in which there are large amounts of non-performing assets sitting on the books of banks, because who would buy them? I mean, it's like trying, an extreme example is, are you going to be able to privatize Air India without the state taking over, a large part of the 50,000 crores of debt and losses it has? I mean, who's going to come and buy an airline with that level of liabilities, besides the fact of it not being a profitable airline at the point of time when you're taking it over? So I do think that's the difference, that this effort to deal with the evergreening of NPAs is a completely different kind of effort. There, Narasimhan basically thought that you can do that by going in for a neoliberal strategy. But what I'm trying to say is it's the neoliberal strategy which has created the current NPA, or not current, the last decade's NPA problem. And because it is that which is creating it, it's difficult for the state to proceed with the other component of its neoliberal strategy, which is privatization of the public banking system, which is what I'm saying gives us an opportunity. Doesn't mean we're going to be successful, but at least it gives us an opportunity. Do you feel that government would have been successful in implementing demonetization in such a large scale, but for the presence of public sector banks? Then why is the government of India so particular in pushing the agenda of privatization of public sector banks? Well, I don't think the government should have done demonetization. That was a disaster. So unfortunately, they used the public sector banks to implement that demonetization. But you're right. I mean, if you actually take 85% of the currency in circulation out of the system, and then say that you can come and over a period of time trade in your old notes for your new notes, you're going to put a huge strain because you're going to get the public banking system to be the conduit through which you actually are not going to, you did. So it's true, but I don't think we should be making a case for public banking because it's a very useful instrument to deal with demonetization. We should basically say demonetization is a complete disaster. It should not have happened. And it was damaging for the economy, for the banks, and for any kind of pursuit of a more progressive, welfare-oriented strategy. Do you support the way the PSBs are being exploited nowadays by both central and state governments to push through their politically oriented schemes? Well, not definitely. See, let me put it this way. Supposing you tell me that should we actually have loan write-offs for, let's say, people who are faced with who are stuck in a debt trap and borrowed from the banking system. If they are borrowed from the banking system, should we have debt write-offs if there is a natural disaster? Should we have some debt write-offs if we have a COVID-19 pandemic? I would say yes, we should, but the point is, does the debt write-off have to be burdened on the book of the banks? No. The debt write-off has essentially to be the state providing the money to actually clear the loans of those whom it says it doesn't want them to be burdened given the specific circumstances, burdened with the responsibility of paying back their debt because it sees them as not being able to do it. I mean, it's not only in a particular country. I mean, after all, we know that debt write-offs have been an instrument which has been adopted in as far as international debt is concerned. Because of the fact that at some point of time you realize that, listen, this is not going to be debt which can actually be repaid, and if you keep insisting of on these countries repaying the debt, then you're actually going to put them in a situation where they're never going to be in a position to be able to take on additional credit. And that's really undermining the whole market, which the international banking system earlier had. So, I mean, I would think that, per se, politically oriented schemes, if you want to call it that, in certain cases, maybe schemes which are necessary because of the circumstances in which you're faced with a sort of deep problem of debt distress. And the point is, however, is that should not be a burden on the books of the banks. It must be something which is actually financed out of the budget of the government on the basis of taxation of those who have the surpluses in our country. Having used the structure of PSPs as per their whims and fancies, the central government now wants to hand over their control to private hands, which will not support the common man's cause. Can this be construed that the government is being run only by some industrial houses bent upon accumulating their wealth and not by people's representatives? Well, I do think that, as I said, that neoliberalism as a strategy is a political strategy. It is a strategy of social engineering in which you want to have an engineered redistribution of income in favor of those who already are the top 1% in terms of wealth holding, the 1% which has 29% of the income which is generated in the country, etc., etc. So yeah, it is because of the fact that the state, a neoliberal state, represents the interests of big business and not, of course, of the people. Will not the recent RBI proposal to deregulate interest rates for microfinance institution lending will bring disaster for poor SHGs run by especially poor women? How can we counter this? Yeah, let me put, let me put it this way. I have a problem with microfinance institutions. Why do I have a problem with microfinance institutions? Because microfinance institutions are not a useful device. But the point is, earlier, the whole notion of actually social banking or of reaching, let us say, credit in small amounts to dispersed borrowers, very often even in remote areas, was that you have to take proper organized brick and mortar banking to the rural areas. This obviously would involve lower profits or even losses as far as some of those, because of the fact that the transaction costs associated with that kind of banking tend to be high. And if you're going to do that, the bank has to be a public bank, because if it is not a public bank, it will be functioning purely on the basis of the profit motive. And if you function purely on the basis of the profit motive, you will not be able to reach brick and mortar social banking to the rural areas to provide credit in small quantities to dispersed, very often remotely based borrowers. Okay. Now, what are these public banks going to do if they have low profits or losses? They don't function. The whole point is, you cannot, like the Narasimhan Committee, look to profits as an indicator of the success of nationalized banks. You have to look at the actual indices which indicate whether the objectives of nationalization were realized or not. And that's why people say that bank nationalization was successful. So you really need to operate in an environment in which you're basically saying that, listen, either the state should cover those losses of the public banks doing this activity, or the public banks should, through a process of cross-subsidization, of using profits it can get, lending in the urban areas, lending to the corporate sector, etc., to partly cross-subsidize the losses it incurs in doing social banking for segments of this kind. So that's the way I would think that you can resolve the problem, and that's what nationalization tried to do. Microfinance institutions, on the other hand, actually, are faced with the same problem of high transaction costs, and therefore the interest rates are already high. The only problem became that is, even when microfinance institutions, when many of them functioned on the basis of what some kind of, social purpose, charitable institutions or whatever you call it, they either were subsidized by grants from donors, or they essentially operated on the principle that, listen, we would have to charge slightly higher interest rates. Now, those interest rates became even higher at a point of time when you allowed big capital nearly over a period of time to enter, like SKS Finance and so on, to enter into the microfinance area, in which case you want even higher uh, interest rates to be charged, because of the fact that otherwise you wouldn't see the value of your stocks appreciating such that you can make huge profits through stock value appreciation in markets in which many of these microfinance institutions tend to even list their stocks over a period of time. So what I see is that this is worsening a problem, definitely. It's worsening a problem, and therefore we have to oppose it. But I think in the long run, we actually have to say that the solution to actually providing credit in a way which is inclusive, to ensure financial inclusion, both in terms of reaching banking services to remote areas and underbanked areas and the poor, as well as in terms of providing credit to sections which deserve credit but are kept out of the credit infrastructure, is to have public sector brick and mortar banking with the state either offering a subsidy or through a process of cross subsidization. Microfinance institutions can play a supportive role, but they cannot be the principal agency. So I think we should do both. We should oppose the liberalization of the interest rates, but we should also oppose the excessive reliance on MFIs as a way of reaching credit to these sections. Do you feel by transferring the NPAs to the state guaranteed bad bank, the PSBs would be attractive for the private investors? No, actually, it's okay. Frankly, perhaps some of you know it. I have not understood what this bad bank is. The only way I can understand it is a set of public sector banks put money to provide the base capital for a new bad bank. Okay. That money, maybe to a certain, basically that money, and a little using that money leverage to borrow, actually provides the capital required to provide the cash component when bad assets are bought up. So you say that, listen, the asset reconstruction company has to have skin in the game, so it has to at least pay 15%. 15% of cash to the discounted value of those bad assets it's taking over. Okay. So first there would be a discounting of the value of those assets. And then of that assets, let's say there's a 15%, 10%, or whatever you fix cash component. The rest are in terms of security receipts. Who holds the security receipts? The bank holds the security receipts till such point of time where the bad bank can actually sell that bad asset and then redeem the security receipts against the money it promises it will pay in case it manages. And of course, as we know now, asset reconstruction companies pay a fee for a period of up to 4 years, 3 or 4 years, till such point of time where you give up the whole idea of trying to, to get back, recover the money. They charge an annual fee for managing these bad assets. Okay. So what's going to happen is, it's not going to be a case where the banks which are selling their bad assets are not going to sell them at a discounted value, which means they have to provision for that loss. They also would have to provision to a certain extent if the security receipts are not considered standard assets, which they cannot be, because there is no guarantee that they're going to be able to sell those bad assets just because a bad bank has taken it over. So the way in which it appears that the government this time around is trying to resolve the problem is to say that it will provide a guarantee. So there would be a sovereign guarantee on the security receipts. So that those security receipts sitting as assets in the books of the bank can be treated as standard assets because there is a sovereign guarantee associated with those security receipts. Now, this is basically postponing the problem because there is no guarantee that you're going to get rid of those bad assets even at that discounted price. And in any case, you have to provide for the discounted price. So it just seems to be some way of actually fixing the books to say that, oh, all these NPAs are disappeared. These banks are now hale and hearty. And I don't see how it can work. We tried it earlier with the ARCs. Suddenly now, all those ARCs, most of which, many of which were created again by banks putting in money, didn't work. And now you're saying that suddenly you announce one more bad bank and that's going to actually resolve a problem which you couldn't using the same instrument. So I really don't understand what exactly they're up to. Okay, and I think the last one here is, can you explain the pressure that can happen on our currency by privatization and opening up of our banking system, as happened in Iceland during the 90s? Well, Iceland was a more, Iceland, basically tried to become a country which would export financial services, and therefore allowed the functioning of institutions which were hugely exposed to the kind of toxic assets which were generated through the period of securitization, creation of layered derivatives, structured products, CDOs, and so on and so forth. So it basically was that you created, it was not on the basis of your real economy, you just became an exporter of financial services, but the financial services was of actually, trying to manage wealth for wealth holders by investing in all of these risky assets, which promised higher returns, but which really didn't materialize. And when the crisis came, those banks collapsed, to such point of time, as finally you had a woman who had to come as a leader in order to try and well, at least not make the people of Iceland pay the full price for what had happened. So I think the situation here is different from that. I mean, I'm not saying that liberalization in India cannot lead up to a situation where we too have, look at what's happening in the stock market. But as of now, we've also had our cases of, banks which have got involved in speculative assets. We also have our securitization, etc. But at the moment, I don't think we are into that problem as yet, partly because it's a public banking, with predominantly public banking system. What is the use of Bitcoin? The use of Bitcoin is to provide an alternative asset to speculators, some of whom will make money and others will make huge losses, as happens in all speculation. Bitcoin is not used at all for real transactions in any significant sense. So it's not money which is used as a means of exchange. It's just supposed to be a store of value, and a store of value whose value in some sense tends to appreciate also, because in the final analysis, at least in the case of Bitcoin, there's only a certain amount of total Bitcoins which can exist in the world after all of them have been mined, even after all of them have been mined. And therefore, you really have a scarcity principle there. So you're creating an alternative asset. It came up at the point of time when there was huge liquidity in the international system, and after, at the time after the crisis and so on. So I don't see any use at all of Bitcoin, and other than as an instrument for speculators. Yeah.
Sir, we have skipped one question in between. The role of finance capital.
Oh, okay. The role of finance capital in dictating such reforms in finance sector was not referred by you. Similarly, now when democracy and constitutions facing severe attack from the present regime, can we hopeful of the window of intervention? Yeah, of course. I'm sorry, I should have mentioned finance capital. But what is neoliberalism? Neoliberalism is the economic ideology for policy making in the age of finance. The rise of neoliberalism coincided with the rise to dominance of finance capital. Okay, so therefore, everything. I would say even trade liberalization is the result of the rise of finance. Because you move to this kind of a, neoliberal regime after you saw the rise of finance, which wanted to break down all barriers for the free movement of money capital. So therefore, if you look at financial sector reform, that is something which is especially, let me put it this way: if in the, let's say, even in the definitely in the 1970s, but even in the 1980s, if you went and looked at a typical IMF program, the structural adjustment and stabilization program, which the IMF was prescribing for a developing country, when it's faced with the balance of payments crisis, it would have things like, necessity for trade liberalization, necessity for devaluing your currency, necessity for holding back on money supply to reduce inflation, etc. But financial sector reform was never part of the original IMF structural adjustment and stabilization package. Whereas today, if you, not today, say from the 1990s, you go to any country, independent of the size, whether it be a Bangladesh or it be a Sierra Leone or it be an India or it be a Brazil, which is entering into an IMF reform, or let's say the miracle countries after the 1997 Southeast Asian crisis. A significant component of the reform package is, of course, a financial reform package, a financial structure package, and this is not only when you are in crisis. So we have FSAPs, financial, sector assessment programs. So the World Bank will give you money to assess the financial sector and to say that, okay, we need the following financial sector reforms in order to support real sector growth. Because unless you have a reformed financial sector, unless you get rid of financial repression, you're not going to be able to use finance to support real sector growth. But well, if you actually look at what is happening, that this program, so independent of the size of the country, level of development, share of industry in total output, level of unemployment or employment, etc., independent of the structural context, independent of the size of the economy, independent of the level of development, you have an exactly similar financial sector reform package. And that is basically because of the requirements set by finance, where it wants to homogenize the financial system, not necessarily because it will go to every country where financial liberalization has occurred, but it wants every country to be financially liberalized so that as and when it might choose to go there, that country, the borders of those countries are open for the cross-border movements of finance capital. So yes, financial sector liberalization is definitely, as a result of the role of finance capital. But as I said, all of neoliberalism is what I see as being a consequence of the rise to dominance of finance globally. When the government is managing to use private sector banks to transfer wealth of the government, recapitalization to private capitalists through write-off, what is the necessity to privatize them now? Well, the necessity really is because the amount of recapitalization which would be required, given the amount of wealth which is being transferred and is being transferred through the IBC scheme, etc. I mean, look at the haircuts on the IBC. I mean, it's just crazy now. Initially there were one or two things, SR Steel and so on, so Bush and Steel, where they said, oh, IBC is very good. But now the haircuts are huge. So the amount of recapitalization required would be so massive that you wouldn't be able to stick by your neoliberal fiscal reform. You wouldn't be able to meet your fiscal deficit targets. You wouldn't be able to give tax concessions to big business. So therefore, if you want neoliberal fiscal reform, you can't recapitalize with government money beyond a point. You need
I think there is some connectivity problem, sir.
Yeah, it got frozen.
is now out of system.
Connecting, but it's not connecting. Any problem in the he's trying to come back, but it is not. I mean, it keeps circling. It's not allowing.
Maybe connectivity.
He's trying. He's coming back.
Okay, right. Chiranjit, please mute Chiranjit.
Comrade Siranjit, is it live in Facebook also, along with YouTube?
No, it's live in YouTube, not in Facebook.
You can make it live in both.
No, there is a problem with Facebook. I'll tell you later.
Yes, comrade. Okay. Okay. Yeah. Okay. 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 You please unmute.
Yes.
Comrade CPC, you please unmute. No, your voice is muted. Comrade? Oh, host not allowing. 1 second.
Let me see. I think now I have unmuted. Okay.
Okay, now it is clear.
I'm so sorry about that. It just went off.
Okay. No problem. No problem.
Yeah, you were
Okay,
answering
sir,
one
no.
question. What is the necessity for privatizing when they're able?
Yeah, so I finished that. I just finished that.
Okay. And one more question. News comes that China is promoting cryptocurrency. What will be its implication?
It's not from, it's the other. China has actually done something which is that it has basically said no Bitcoin in China. And the reason why was because of the fact that there was so much power being consumed by the Bitcoin mining sector. So they've removed. So all of these Bitcoin units are now searching for new locations. Kazakhstan, US, they're trying to go somewhere else. But I think they're going to, what is online is because countries are thinking of having their own digital currencies. And central banks of countries are thinking of having their digital currencies, which is a very complicated thing, because it basically would mean that the intermediation by banks would be cut off completely, because you would be directly dealing with an account at the central bank. And therefore, you don't need to operate through the banking system. So it's unclear yet, though there's talk and there's discussions even in the Bank of International Settlements and so on, whether digital currency should be included. But what exactly is going to be the shape of the banking infrastructure associated with the digital currency is not at all clear, because the digital currency can only be introduced by the central bank. And if it's introduced by the central bank, then I as a holder of digital currency, do I hold it in an account in the central bank? Or do I hold it through a banking system? Why do I need to hold it through a banking system and pay an intermediary fee of some kind? So it's not yet clear. But so the thing is not cryptocurrency; it is digital currency, and that is going to be something which, well, there's one Latin American country which has started, but many countries are saying that we are considering it. Many central banks. But as yet, it's unclear what is going to be the infrastructure associated with it.
Okay, sir. Thank you very much for your kind presence and providing us with a very wonderful and meaningful evening. Now I request Comrade C.P. Krishnan to propose a formal vote of thanks.
My dear comrades, really it was a wonderful session. Effortlessly, Comrade CPC could explain the present scenario and how things are going in the way the government is deciding, and how they are able to convert, even in the present scenario, the public sector banks to amass wealth, and how difficult it is to privatize in the given circumstances of fiscal deficit and other constraints. So now there is an opportunity still for all of us to fight against this privatization, and that has been well explained. Thank you, Professor CPC, for having explained everything in detail and in a very lucid and in your inimitable style. I also thank Comrade C.J. Nandakumar for having presided over this function and concluding it in a time-bound 90 minutes. And also I thank Comrade Debashish Basu Chaudhary, who welcomed the whole gathering and threw light on the issue. And also I am thankful to all the comrades who participated, also viewed it in the YouTube channel directly. I thank one and all. Thank you all.
Hey, thank the team who has hosted this.
Yeah.
Okay, we will again meet on 26th, 7 p.m. for next program.
Okay, thank you for having me, and I'm extremely sorry about that disruption.
No issue.
No, sir.
It was a very wonderful session. Wonderful session. Very enlightening.
Very much.
You could do it effortlessly. That was the. Thank you, Comrade.
Okay, right. Okay.
Session is concluded.
Bye.